Ever felt like your hard-earned money is disappearing into taxes? Let's discover how smart savings can unlock significant reductions in your taxable income, turning those tax headaches into financial advantages. Step 1. Understand your fundamental tax advantage. Many savings schemes are designed to directly reduce the amount of income the government taxes, known as your taxable income. Think of it as shrinking the pie before the tax slices are taken. Step 2. Explore tax-deductible savings. Public provident funds, or PPF, are a classic example. Contributions made to a PPF account are eligible for deduction under Section 80C of the Income Tax Act, directly lowering your taxable income. Step 3. Leverage exemptions beyond direct deductions. Certain savings and investments offer exemptions on the interest earned or the final maturity amount. For instance, interest earned on specific government schemes might be tax-exempt, keeping more of your returns in your pocket. Step 4. Recognize the power of investment planning. Equity-linked savings schemes, or ELSS, not only offer the potential for market-linked growth but also qualify for deductions under 80C, all while having a lock-in period that encourages long-term financial discipline. Step 5. Maximize your financial prudence. By strategically utilizing these savings instruments, you're not just minimizing your current tax liabilities. You're actively building a more secure financial future through smart, tax-efficient wealth creation.